Tax planning is not just something you do when tax season is around the corner. It is a year-round process that helps you legally minimize the amount of tax you pay and keep more money for yourself, your family, and your future. In this step-by-step tutorial, we are going to walk through the process of tax planning from start to finish so that you can make informed decisions, avoid last-minute stress, and take full advantage of the opportunities available to you. Whether you are an employee, self-employed, or running your own business, the principles in this guide will help you manage your taxes in a smarter way. Step 1 is understanding your tax situation. Before you can make any kind of plan, you need to know exactly where you stand. This means identifying all your sources of income, knowing your tax bracket, and being aware of the types of taxes you are responsible for. The taxes you pay depend on several factors, including your income level, the state or country you live in, your family situation, and your type of work. For example, if you are an employee, taxes are generally deducted from your paycheck automatically. But if you are a freelancer or small business owner, you will likely need to make quarterly estimated tax payments yourself. Reviewing last year's tax return and your current income sources is a great way to get a clear picture of your financial position. Step 2 is setting clear financial goals. Tax planning is not just about lowering your tax bill. It is about making decisions that align with your long-term financial plans. If your goal is to retire comfortably, for example, you might decide to contribute more to your retirement accounts because that can both reduce your taxable income and build your savings. If you are saving to buy a house, you might focus on strategies that help you put away more cash while still taking advantage of deductions. Your goals will guide the choices you make throughout the year. Step 3 is keeping accurate records. This is one of the most important parts of tax planning. Without organized records, you could miss out on deductions and credits you qualify for. Keep track of receipts, invoices, bank statements, and any other documents that prove your income or expenses. For those who are self-employed or own a business, this includes things like mileage logs, home office expenses, and supplies. Staying organized throughout the year will make the filing process much smoother and help you avoid costly mistakes. Step 4 is knowing your deductions and credits. Deductions lower your taxable income, while credits reduce the actual amount of tax you owe. For example, if you have a taxable income of $50,000 and you qualify for a $5,000 deduction, your taxable income becomes $45,000. If you then have a $1,000 credit, that amount is directly subtracted from your tax bill. Common deductions include mortgage interest, student loan interest, charitable donations, and certain medical expenses. Popular credits include the child tax credit, earned income tax credit, and education credits like the American Opportunity Credit. By understanding which deductions and credits you qualify for, you can plan your spending and contributions in a way that benefits you the most. Step 5 is adjusting your withholding or estimated tax payments. If you are an employee, you can adjust the amount of tax withheld from your paycheck by updating your W-4 form. If you typically owe a lot of money at tax time, increasing your withholding can help you avoid underpayment penalties. On the other hand, if you always get a large refund, you might be giving the government an interest-free loan. If you are self-employed, you will need to make quarterly estimated tax payments. Calculating these accurately helps you avoid penalties and keeps your cash flow stable. Step 6 is making use of tax-advantaged accounts. Retirement accounts like 401k, traditional IRAs, and Roth IRAs provide powerful tax benefits. Contributions to traditional accounts may be tax-deductible, reducing your taxable income for the year. Roth accounts, on the other hand, do not offer a deduction up front, but grow tax-free and allow for tax-free withdrawals in retirement. Health savings accounts, or HSAs, are another powerful tool because they are triple tax-advantaged. Contributions are tax-deductible, growth is tax-free, and withdrawals for qualified medical expenses are also tax-free. Flexible spending accounts, or FSAs, can also help you save on taxes if your employer offers them. Step 7 is timing your income and expenses. In some cases, shifting income or expenses from one year to another can lower your tax bill. If you expect to be in a higher tax bracket next year, you might delay receiving certain income until that year to avoid paying a higher rate now. Conversely, if your income will be lower next year, you may choose to accelerate certain expenses or charitable contributions into the current year to maximize their tax benefits. This type of planning is especially useful for business owners and freelancers who have more control over when they receive income and pay expenses. Step 8 is staying updated on tax law changes. Tax laws change frequently, and something that worked in the past might not be the best option this year. The government often updates rules, income limits, and deductions, and these changes can significantly impact your tax planning strategy. Keeping up with these updates through the IRS website or by consulting a tax professional will help you make informed choices and avoid surprises. Step 9 is seeking professional advice when needed. While many people can handle basic tax planning on their own, certain situations are more complex. Owning multiple properties, having significant investments, or running a business can make your tax situation more complicated. In such cases, working with a certified public accountant or tax advisor can help you identify opportunities you might miss and ensure you stay compliant with all regulations. A good tax professional can often save you far more money than the cost of their services. Step 10 is reviewing and adjusting your plan regularly. Tax planning is not a one-time activity. Your income, family situation, and financial goals can change throughout the year, and your plan needs to adapt to those changes. Review your strategy at least once a year, and after any major life events such as marriage, divorce, having children, or starting a new job. Regular reviews ensure that you are always taking advantage of the best strategies available to you. In conclusion, tax planning is about being proactive rather than reactive. If you wait until tax season to start thinking about taxes, most of your opportunities to save will already be gone. By following these steps throughout the year, you can minimize your tax liability, avoid unpleasant surprises, and keep more of your hard-earned money. The earlier you start, the more options you have. Whether you are just starting out in your career or managing complex finances, a solid tax plan will give you control, peace of mind, and a clear path to achieving your financial goals.